now turning bearish and quite bearish. For the December 14th meeting that you're speaking about, I think now that the Fed is either, after the 14th meeting, 90 or 100% of the way done.
Hello and welcome back to Cryptollennium. That was just a clip related to today's job data. Before we dive into why the market is likely to potentially decline over the next few weeks, a quick update on the ANKR protocol hack. So without further ado, please like and subscribe, and let's dig in. ANKR says no one should trade A, B, and BC. Only LPs caught off guard will be compensated. The company stated it will be discontinuing A, B, and BC and A, B, and BB tokens effective immediately, and that new ANKR BNB tokens will be minted and airdropped to the affected users. Following yesterday's confirmed multi-million-dollar exploit, BNB chain-based protocol ANKR took to its company blog on December 2nd, today, to relay its next steps. And this is the blog post. If you want to take a look at it, go check it out. I'm sure there's a lot of thorough detail in how they will reconcile this problem. But as a summary, the group said it also assessing collateral pools such as Midas and Helio. According to the post, ANKR intends to purchase $5 million worth of BNB, which will be used to compensate liquidity providers affected by the exploit. However, the company said it only intends to compensate the LPs that were caught off guard. They're doing something good. They are taking care of this issue right away, and seems like they're doing okay. Hopefully this stays like this, but time will only tell. And for the most important point for today, U.S. economic data foils Bitcoin bulls' rally attempt to retake $17,000. Bitcoin is retracing and might be at the end of a short-term bullish momentum. Macroeconomic data may have shifted against it. Let's see why. So as we saw, Bitcoin was at about 17,000. It still is actually. Failed to hold it, dropped under 17, but now just reclaimed 17 today, December 2nd. And so this is fairly new. Bitcoin continues to struggle. A new status quo is in the making. What they're talking about is the job numbers that just came out today. So non-farm payrolls and private payrolls came in a lot hotter than expected. The market was expecting much lower results. Metrics recorded 263,000 and 221,000 respectively. This hints at a strong job market, which contributes to inflation, and the Fed doesn't want inflation. So this could be a catalyst for them to shift what they said a few days ago about potentially decreasing the rate hike. And that 50 basis point rate hike that everybody was pricing in the last 2 days is likely to be 75 basis points. There's a lot of layoffs and unemployment is high and inflation continues to still be high. That's what you call stagflation. And stagflation is what you saw in the 70s, where we went sideways for like 10 years. Not a good sign. This tweet just shows the exact piece of data. So oops, no Goldilocks jobs data, a bit too hot. And as you can see, payrolls were a little bit higher than the previous ones right here in this column. On the other hand, this well-known Wharton professor, Jeremy Siegel, doesn't think that today's job report is that concerning and is that hot. We'll play this clip right after the most important piece of data in this entire video, miners. We talk about miners a lot over the course of this page, and they are an important metric to take a look at to see the health of Bitcoin as a whole. And it's not looking good right now. So Bitcoin bearish signal MPI records highest value since April 2022. What does this mean? Well, the miners position index is an indicator that measures the ratio between miners outflows in USD and the 365-day moving average of the same. Generally, miners transfer coins out of their wallets for selling. Thus, the MPI can tell us whether a miner is selling less or more compared to the past year average. And right now, it is not looking good. Take a look at this graph. We'll go in just a tad bit more. Right here and right here. In comparison to April 2022, quite a large spike. So what this means is we're likely to see some bearish momentum after this. Whenever the Bitcoin miners position index has crossed above a value of 2 during the past year, the price of the crypto has seen a decline shortly after. And there have been 5 such spikes in 2022, so far the latest of which has only been recorded in the last 24 hours. This is a big deal. Keep an eye out on the market because this is a very strong signal that something is about to happen, and it might not be to the upside. But for those of you who stuck around, let's take a look at what the Wharton professor explained about this job numbers data that came out and why he doesn't think it is too concerning.
What's likely to happen in the last days of this lousy year for the markets? Let's ask Wharton Professor of Finance Jeremy Siegel. He joins us once again here in Overtime. Professor, welcome back. It's great to see you.
Good afternoon, Scott.
Came a long way from those mid-October lows, Professor. Where are we going from here? Do we have room to run into the end of the year, or did today's jobs report derail that?
No, I don't think so. And by the way, I did not regard today's jobs report as hot. I mean, first of all, the household data was negative, minus 150,000. And something else that was just mentioned in the last segment, but it's very important. People ignore the hours worked, and that fell. And even though it only fell 1/10 of an hour, that's equivalent of over a 200,000 loss of payroll individuals. I mean, what is the input into the economy is not just the number of people, but how many hours they work. So I didn't regard this as, I mean, it wasn't a terrible report, but I didn't regard this as anything on the labor front as being a strong report. Now let's go to the wages.
Let's go to stocks.
No,
let's go to stocks for a minute. Let's go to stocks for a minute, Professor, because we had a pretty nice comeback today, right? We're down 350 at one point after that report came out, and we've come back, right? The Dow closes positive on the day. You've got the S&P 500 above the 200-day moving average. So you think this clears the way for?
Well, I think what happened during the day was people were beginning to say this isn't that hot. And by the way, look we had 5% year over year wage growth. We have 8% inflation. Workers are trying to catch up, and they're not. They're still falling well behind. I mean, it just disturbs me to think that the Fed's policy is to crush wages so they go back down to 2%, are basically saying to the worker, you're not going to catch up to inflation, and we're going to prevent you from catching up to the inflation. That's an insane policy. And by the way, I mean, I've talked to, Bullard about wage inflation. He said, I don't look at that wage inflation when I try to choose or determine what price inflation is. And he's an uber hawk. So, I mean, this idea that, the worker trying to catch up because he's lost so much purchasing power is something that the Fed has to crush, to me, is extraordinarily bad Fed policy. And I don't think it's inflationary, because it's inflationary when wages jump ahead of prices, not when they lag behind prices. And I think what's happened is the market is I think what happened today was beginning to say is, well, when we look at the price, look what happened to ISM prices yesterday. I mean, that was outside of the few months following the pandemic. That was the first decline in 15 years. And all the other price indexes that we've been talking, all of them are, basically going down. So people are saying, despite the wage catch up, the price action is going to be amenable to the Fed greatly slowing down. I mean, my feeling is it's 50. And, my feeling is the data is going to come in that they won't even have any next February. But we'll have to see what happens. They're not indicating that now. But if that does happen, wow, that's good for stocks, good for bonds and stocks.
Yeah, you said a few weeks ago that inflation was basically over. That's what you told me.
And I still believe it, because I don't think this wage increase is catch up. And I don't think that this wage increase by itself is inflationary. Everything else that I see on the price front, everything else, and I mentioned the ISM, case show or house index down again, big. House prices turning, rental indexes are turning negative. I mean, it's not only a slowdown in inflation, it's actually negative inflation on many of these important categories is still coming through. And, we've talked about the fact that, the BLS index and the Fed index lags on the housing. It's going to continue to show those housing increases, which, is going to, if the Fed wants an excuse to keep on raising rates, they're going to point to what I consider a faulty index and not an on-the-ground index of what's happening. And more people are, writing me and saying, yeah, I think that that's actually the case. There's more not cognizant. So I am not changing my view that, inflation is basically over. This is catch-up wages, and the Fed should not be setting policy to go against that.